What is post-shipment financing? Post-shipment financing refers to the short-term financial assistance provided to exporters after goods have been shipped, but before payment is received from the importer. It bridges the gap between the date of shipment and the realization of export proceeds, helping exporters maintain liquidity and continue operations while awaiting payment. This financing is typically extended by banks or financial institutions based on shipping and export documents such as the bill of lading, commercial invoice, or letter of credit, LC. It may be denominated in either domestic or foreign currency and is usually self-liquidating, meaning the loan is repaid when export proceeds are received. Why is post-shipment financing important? Post-shipment financing is critical for exporters who need immediate working capital after dispatching goods. Exporters often face long payment cycles, especially when selling on open account or usance LC terms, which can tie up significant cash flow. Post-shipment finance ensures liquidity and business continuity. Working capital support provides immediate funds for operational needs while awaiting payment from buyers. Risk reduction reduces liquidity and credit risks by allowing exporters to convert receivables into cash. Increased competitiveness enables exporters to offer favorable payment terms to foreign buyers, enhancing global competitiveness. Financing flexibility available under various payment arrangements, letters of credit, documentary collections, or open accounts. Encourages export growth. By ensuring liquidity and stability, post-shipment financing promotes international trade expansion. What are some of the risks involved in post-shipment financing? Credit risk. The importer may default on payment, leaving the exporter and the financing bank exposed. Documentary risk. Discrepancies in shipping or trade documents can delay or invalidate payment under a letter of credit. Foreign exchange risk. Fluctuations in exchange rates between shipment and payment dates can erode expected returns. Political and country risk. Political instability, war, or sanctions in the importer's country may prevent payment transfer. Commercial risk includes buyer insolvency, delayed payments, or rejection of goods. Liquidity risk. The exporter may face repayment pressure if export proceeds are delayed. Fraud risk. Submission of fraudulent or falsified documents can result in significant losses to banks. Operational risk. Internal processing errors or miscommunication between banks and exporters can delay funding. Types of post-shipment financing. Export bill purchase or discounting. Banks purchase or discount export bills, sight or usance, drawn under documentary collections or open account terms. The exporter receives immediate payment, less a discount or interest charge. Negotiation of documents under letter of credit. When documents are submitted under a letter of credit, the negotiating bank examines them for compliance with LC terms and provides advance payment to the exporter before receiving funds from the issuing bank. Advance against duty drawback. Exporters are eligible for duty drawback or tax refunds from the government. Banks may advance funds against the receivable duty drawback claims, which are later settled when government payments are received. Export factoring. The exporter sells export receivables to a factoring company or financial institution at a discount. The factor assumes the risk of non-payment and manages collection from the importer. Forfeiting. Used for medium to long-term receivables, 180 days to 5 years. Exporters sell promissory notes or bills of exchange to a forfeiter, who assumes full credit and political risk without recourse to the exporter. Advance against export incentives. Exporters entitled to government incentives, such as subsidies or interest equalization schemes, can receive advances from banks against these claims. Export credit insurance-backed financing. Banks provide post-shipment credit secured by export credit insurance from agencies like the Export-Import Bank, XIM, or Euler Hermes, which protect against importer default. Buyer's credit. A loan extended by a foreign financial institution to the importer, enabling payment to the exporter. The exporter receives full payment up front, while the importer repays over time. Parties involved in post-shipment financing. Exporter, seller, ships goods and applies for financing against shipping documents or receivables. Importer, buyer, responsible for making payment according to agreed terms, LC, DA, or DP. Exporting bank, negotiating or discounting bank, provides post-shipment finance by purchasing or discounting bills or negotiating documents. Issuing bank in LC transactions, guarantees payment to the exporter's bank upon compliance with LC terms. Export Credit Agency, ECA, provides insurance or guarantees against political and commercial risks, e.g., ECAs Bank, UK Export Finance. Forfaiter or factor, purchases export receivables without recourse to the exporter. Government authorities involved in incentive schemes, duty drawback programs, or export subsidies. Insurance companies cover non-payment, shipment, or currency-related risks. How is post-shipment financing is used? Shipment of goods. The exporter ships goods according to the sales contract and collects the required shipping documents, invoice, bill of lading, packing list, etc. Point, submission of documents to the bank. The exporter submits documents to their bank along with an application for post-shipment finance under letter of credit, collection, or open account terms, point, verification, and approval. The bank verifies the documents for compliance with international trade standards and LC requirements, if applicable. Disbursement of funds. Upon approval, the bank disburses funds to the exporter, either as a loan or by purchasing discounting export bills. Realization of export proceeds. The importer makes payment according to the agreed terms. The issuing or collecting bank receives funds and settles the post-shipment finance account. Closure of loan. Once proceeds are received, the bank credits the exporter's account and closes the loan facility, deducting interest and fees. Reporting and compliance. Banks and exporters report export realization to regulatory bodies and ensure foreign exchange compliance, e.g., submission of export declaration forms. This concludes our discussion about post-shipment financing. See you at the next lecture.